Well, that brings to a question. There's been some criticism in the marketplace that the stress tests were not stressed enough. That the scenarios that they plan or they put in place or they're looking at were not as rigorous as they should be. What would your response to that be?
Well, I would say an important thing that you have to understand in terms of a stress scenario like we've seen is the concept of pro-cyclicality. Ideally, what should have been happening all along, so what should have happened is in the good times, the bank should have been setting aside more capital to prepare for the stress scenarios. So when you have a time like today, the worst thing you could do for a bank that's trying to grow out of this problem is to require more capital to restrict their ability to make more money. So the ideal would have been to have a framework where they have to store up more reserves in the good times so that they're ready in the bad times. So I would have to say that in an already stressed scenario, further stressing the market conditions is probably going to be sufficient. I mean, the GDP shock I don't think has ever happened. Housing prices are already down dramatically, and then going down another 25% was something pretty big. And unemployment is already fairly high. Going over 10%, that's possible. I mean, I'm not sure if they made it 15% or 20% that would have made much of a difference, because everybody would have been in trouble.
Right.
So I think they were okay. The question is how did the numbers all wash through, and how consistent were they in terms of looking at their balance sheets and put in conjunction with the drivers that they were told to run through the models.
Right. What are the conversations that you're having with the banks going forward?
Yeah, I think, Emmanuel, you hit on a really good point. This exercise is putting focus the way that an organization should be managing their bank going forward. I mean, you can't just look at the impact on losses. You can't just look at the impact on market risk. You have to holistically look at the organization. You have to be able to calculate income. I mean, obviously, the focus has been on capital and capital planning, of course, with the stress test and with the crisis. I mean, obviously, how can you ignore the liquidity aspect? So holistically, organizations are looking at pulling this risk together and seeing how these drivers are going to affect their balance sheet going forward, because there are a lot of interesting dynamics that happen within an organization when you're doing a stress test, and that's what the stress test is designed to do. The VAR-based ones give you some information. How much am I going to make or lose based on what happened in a particular time? I mean, there's still a place for that, but that needs to be used in conjunction with things like a board of directors can understand. I mean, the good thing about a stress test is, say 2 years ago you were looking at your California portfolio, you had a lot of teaser rate loans that had, for example, no income verification to make the loan. If you had to run a very simple stress test, well, interest rates go up a little bit and housing prices go down a little bit, you could have very easily seen that would have tanked your entire California portfolio as loans readjusted up in value, and therefore there was no more money to take out to refinance the loan. And the credit risk was obviously, some of those loans, 50 or 60% of them, didn't pay at all. So I mean, it was pretty easy to see a scenario like that would have worked. VAR is not going to help you there, but the scenario stress testing is a good way to take a look at, and it's useful for people outside of finance. And I smile a little bit because I realize some of the shortcuts that were taken in order to get the numbers out, and how it could have been done better. But I think it's going to have a positive impact on the way organizations manage their risk and manage their profitability going forward. So you can't ignore income as part of this, because income is how these banks are going to be growing out of it.
Right. Do you see more banks coming to you and asking you to repeat this whole process internally, whether or not they're required to do a stress test?
Well, see, that's the thing. The repeatable process. This is not a one-time sort of an exercise for the
That's
regulators.
what you wish it is.
And so really what you want to do is put in a process in place so you can very easily run this or anything else that they dream up. So I mean, for us, this has been what we have, I mean, as you've known me for several years now, this is the exact type of methodology that we've been preaching since we added the ability to do credit risk and Pillar 2 stress testing to our analytical framework 7 years ago. So we've been on the forefront of this, and in our organizations that had early on added the ability to do the credit risk piece on top of the ALM and VAR and the Basel piece, had a much easier time working with this. I'm not going to say that it was perfectly easy as well. So I mentioned the 15 of the 19 of those organizations were QRM clients. Not all of them had engaged us for credit risk, which means the economic scenarios and the credit modeling needed was just not there at their fingertips. So obviously that's been a very big avenue for us. People, we have you already for part of this. Can we just get the other part in? And globally, it makes perfect sense to have to look at these things. Liquidity is a really big thing in the UK right now, and they have this ILS 0822 regulation by the FSA, and the organizations are having to look at how liquidity is impacted on their balance sheet. But when you read into that, it's really what is the stress test, and then how loans, how their funding is going to roll over, and how credit impacts that. It's really all the same thing. So I mean, during the crisis, obviously, it was a double-edged sword. I mean, there couldn't be any better publicity for deliver this. It's been a very challenging and excellent time for us.
You should have included liquidity, and if it did, it would have required less strenuous scenarios as a result, because liquidity is something that can keep the bank going.
Part of the issue that we needed to overlay onto the prescribed scenarios was an interest rate scenario, of course, but another effect is going to be interest rates, and you could have also done exchange rates as well, right? So the interest rates there's an implied interest rate scenario that has to go along with the government stress test scenario, because that interest rates are going to drive prepayments, they're going to drive reinvestment. And so that needed to be in there. So I mean, that was one of the missing parts of the stress test, where they could have also put in rates go up, rates go down, rates stay the same. Obviously, as the movement of rates affect what? Well, your funding charges. But right now, funding charges are so low,
right,
and the liquidity is not frozen. I think they just left that one for another day.
Well, is there anything in the data that we might misread, or we can read wrongly, or runs into the risk of being misunderstood?
Behavioral type models are limited by the sample set of which the prepayment and the default and recoveries are designed. VAR type models are limited by the history in which they were designed, over which they were compiled. And then the results that came out, again, should be looked at more as a ballpark or a starting point to the same types of modeling assumptions that all quantitative modeling is subject to.
Charles Richard, thank you very much.
Thank you.